In chapter 12, what we're trying to do is kind of understand what are kind of the steps to crises and regulations. If I were to make this lecture, I'd make it really simple. Right? If we didn't have slides, we didn't have a chapter, we didn't have questions and whatnot. What if it was just me talking to you, and your simple question to me was, what is it that creates a financial crisis? And it would be basically this narrative is that modern developed, and this is just going back to what we talked about, what I talked about at the beginning of this entire course, is that modern developed economies are built on credit, on the fact that some individuals save, some individuals borrow, and that is what allows some individuals to take risks to build and expand and help the economy grow. Modern developed economies are built on credit. And the elimination of that, sudden elimination of that credit, will destroy a modern developed economy almost instantly. And that is right there, your financial crises. Your financial crisis is when the entire strength of your modern developed economy is in question because the credit no longer exists. Okay. So, at least in your lifetime, you've had a pretty interesting lifetime because many of you would be born before 2008, 2009, which was a financial crisis that the only comparison we can really make is the Great Depression. The 2020 crisis wasn't as scary. And this is coming from me, who kind of had lived through both and was old enough to kind of properly process both. COVID was scary for the economy, but it wasn't anywhere near as scary as 2008, 2009. What was supposed to be a housing bubble that was supposed to be quite isolated turned out to be anything but that. And we literally came within hours of 24 to 48 hours of the entire global economy collapsing. I'll repeat that again because that's not me over exaggerating here. That in the 2008 2009 financial crisis, we probably came within a day or two, 24 to 48 hours of complete global collapse. Yeah, it was that bad. And these crises are pretty difficult to predict in general because they don't happen very often. We can talk about bubbles existing, and yet even me as a person, again, who at that time, I would have just left the Federal Reserve, so I still had lots of contacts within the Federal Reserve. None of us were really talking about a financial crisis happening. We knew that there was a housing bubble. We knew that that bubble was going to pop. We knew that it was going to be bad, but lots of PhD economists, myself included, none of us really predicted the extent to which there would be a financial crisis. We knew there was a bubble, but not that there was a crisis. And if you're finding already that this lecture is really interesting, then the best book would be to get this book called Manias and Panics, I think. Let's see here. It's got a red cover. It's a good book. It's a good read. Manias, Panics, and Crashes. It's a really good book. So if you're interested in that kind of stuff, it's a really good history of how financial crises have existed in the past. Okay. So let's look at what typically is happening here. In a financial crisis, The reason why it's called a financial crisis is that there's something that breaks down the flow of money between borrowers and lenders. So because of that breakdown, lending stops, and then generally what happens is that people stop saving money as well within the banking system. It not only then causes a recession as kind of businesses start to stop borrowing, but then it also, that recession causes people to save for precautionary reasons, which then makes the downfall of the economy even stronger, and it cycles back even more and even more and even more. And this is not the same financial crisis. We're not talking about stock market falling. Stock market is a useful shadow variable here, but it's not the same thing. A financial crisis is really the breakdown of the economy as a whole, the banking system as a whole. Recession is like the worst, the least of the problems at this point. The system is much more disrupted than that. And that usually, we saw this a little bit. We saw the very, 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 very beginnings of a financial crisis last year, but it was stopped pretty quickly. And that was when, again, Silicon Valley Bank and a series of banks failed because they had mismanaged the interest rate risk. So they had that liquidity risk. And again, it was the very beginnings of it, but Federal Reserve Bank was very worried about it, and it's starting an entirely new financial crisis, and they stopped it right away. Now, the reason why that didn't happen in the 2008 crisis was that there was a great deal of concern about moral hazard and the extent to which it would stop banks from, it would stop banks from trying to control the risk because they knew they would be bailed out. In some sense, we didn't care about that anymore with this most recent crisis in 2023. Because what ends up happening is that as the crisis gets worse and worse, banks then have to borrow or sell assets to raise money, thus causing concerns and causing more banks to start to go under. And you get this larger and larger insolvency that starts to exist, where the bank doesn't have any net worth in which to draw upon to be able to pay back depositors. A crisis. Now, we used to see these bank runs much more often, where people would line up. But even in 2023, with Silicon Valley Bank failing, there was still a bank run. It just took a different form. Instead of people lining up, like you would see in like movies like It's a Wonderful Life and whatnot, where they line outside the door to be able to withdraw their money, the bank run looks a lot different. The bank run instead, so there's a really good article in the Wall Street Journal last year about the bank run. Let's see here. It's taking too long. Anyway, in the Wall Street Journal, if you look up Silicon Valley bank run, you'll see a pretty interesting article where basically big companies that had their deposits at Silicon Valley Bank were talking to each other in TikTok and in Slack and other kind of corporate methods of communication to be able to kind of withdraw their money quickly. Bank runs were largely stopped when the FDIC was created. The Federal Deposit Insurance Corporation wasn't started in 1934. And it gave confidence to depositors that they didn't need to be worried about their bank account balance. That's largely what we see and what we rely on today. The problem would be either you start to question whether the FDIC is going to be able to make the payments, or you've got your deposits and they're uninsured, or people just don't want to deal with banking with a bank that's about to go out of business. And the problem can also be is that the FDIC starts to run out of money, to be able to pay the depositors, that people might get concerned about those things. And that's where you've got contagion. And that's another kind of step that happens in a financial crisis. And again, we saw this certainly in the 2008-2009 crisis, where financially strong banks that just happened to be selling mortgages also found themselves in a troublesome spot. And it causes this, again, larger panic, where then people start getting concerned and irrationally take out their money because they're concerned that nothing is going to be there. And again, no bank is set up to support individuals kind of rushing in to take their money all at once. So, of course, they fail, thus fulfilling the prophecy that the bank was weak and was going to fail. So what do? Well, we do this in two ways. In the beginning, when we created the Federal Reserve System and it was operating in 1914, we had the Federal Reserve as the lender of last resort, that it makes loans when others can't. And we certainly saw this with Silicon Valley Bank. We saw this in the 2008-2009 crisis. We saw it during the savings and loan crisis, quite frankly, where the Federal Reserve basically just creates the money and then lends it out to banks. And it makes those loans based on good but illiquid loans, assets, meaning like treasuries and whatnot. But the bank ultimately is probably not going to exist in the same way anymore once it turns to the lender of last resort, the Federal Reserve. The only other way we try to employ stopping a bank panic would be that you would know that your deposits are insured by the FDIC, the Federal Deposit Insurance Corporation, or if you belong to a credit union, by the NCUA, which is basically the same thing. Which basically, right, if you have less than $250,000 in your bank account, you don't really worry about whether the bank is going to exist or not. This is essentially what we rely on today in our fractional reserve banking system. Now, there are other ways to do it. We have a fractional reserve banking system, but banks are no longer really required to hold any required reserves. In the 1950s, Milton Friedman had suggested that banks should actually try to hold 100% reserves as a way to kind of stop the Federal Reserve from intervening in this kind of way. And then and Milton Friedman would be a quite conservative economist. And then you get Lawrence Kotlikoff. It's also pretty conservative, I think. Same thing, advocating for 100% reserves, and that banks then basically only make their loans based on either shareholder equity or just kind of profits that they've retained. It certainly would stop bank runs, right? We could talk about this, but if the class was in person, we could talk about it. But obviously, it would stop bank runs, but it would also limit the extent to which banks are earning profits because now they're just holding these reserves and it's just sitting in their vaults, which doesn't do very much for them. So typically, bank panics and recessions go hand in hand. Here's just kind of a brief listing of various bank panics that we've had. And almost all of them are associated with a recession. The only exceptions occurring during the Civil War, when the government had a pretty, war is good for business because you're breaking things, basically, and businesses then replace those broken things, and the government is your willing partner in buying those things. So out through 1934, out through the Great Depression, bank panics and recessions went hand in hand. And so what you see here is that with the 1907 recession and bank panic here, Theodore Roosevelt was the president, and he was unhappy with the idea that the richest American at the time, J.P. Morgan, had to bail out the United States, the whole government, because of this banking panic that had happened. And he hated this idea that the government had to rely on a rich person to bail it out, right? Roosevelt, as a president, was against like trusts and rich people, and just hated this whole idea. So his plan was again to put in place the creation of the Federal Reserve Bank to kind of step in for the role of the rich person and whatnot. And so the Federal Reserve comes into existence in 1914, but doesn't really do very much until after the Great Depression is done, which again is one kind of the causal agents of the Great Depression is that the Federal Reserve did nothing. Some would even say did the wrong thing to cause the Great Depression, which would be Ben Bernanke, the former Federal Reserve chairman. That was the whole topic of his PhD dissertation was the Great Depression and the role of the Federal Reserve at that point, and trying to find causes for the Great Depression and why it took so long to resolve itself. And we can kind of look at the literature here. There's some interesting research on this, and if you're interested in this kind of stuff, if you're really wanting to find some of this research and you can't find it, just let me know and I will send you PDFs of these things. I'm not going to make them available because I'm doubting some people will look at them. But what you see is this quite destructive feedback loop, where the panic gets worse and worse and worse. And this is the nature of a crisis. This is exactly what happened in 2008 and 2009. And this is exactly what was stopped in 2023. So in 2023, we stopped it right here before it got to a contagion. You had bad news coming out about certain banks in California and in New York that held all these treasuries that were paying a low interest rate and had all these loans and were losing a lot of money. People saw that their bank was in the news and they went and they took their money out. And then the Federal Reserve and FDIC stepped in and bailed out those banks and said, stop doing it. Thus stopping the contagion, the reaction, and the economic effect. And then one would say is that this didn't happen in the 2008-2009 crisis, where the bad news came out that mortgages were underperforming, that people started going to their banks and asking for their money back, or people stopped paying their mortgages, and then it spread to other banks, and then other banks had to find other sources of money or had to borrow from the Federal Reserve, and it affected the economy as a whole, thus causing more bad news, and so on and so forth. And that's your story from 2008 all the way out through at least 2012, 2013, an incredibly long feedback loop. And again, that's kind of what you see here with the Great Depression. There is an entire chapter on the shadow banking system, chapter 11, but unfortunately we had to skip that. So let's, these would be financial institutions that are not banks. So this would be kind of like investment banks and also kind of other credit providing agencies. But what we can see is that in terms of that financial crisis that existed in 2007 to 2009, is that the economic effects were quite significant, that the economy shrunk on a real basis by 10%, stock prices fell by half, and that government debt almost doubled. That's pretty significant. It was a longer recession. It was a more severe recession. It was just bad in every way, shape, and form. And it fundamentally altered the trajectory of the economy and how people searched for jobs, how people planned how many kids they were going to have, all the different ways in which recessions affect individuals. And it also affected exchange rates. It affected exchange rates between the Korean won and the U.S. dollar. Here, the Korean Central Bank, and again, we skipped over kind of exchange rate discussions here, but it affected economies that pegged their exchange rate to the dollar. Because in a crisis, you kind of gravitate towards the U.S. dollar, which then strengthens the US dollar and weakens other currency, causing even worse problems in those other countries as their currencies become devalued. And you get to this situation where the currency is becoming more and more devalued, where you can actually get sovereign debt crisis. And this happened also in the 2007 2009 crisis, where entire countries like Iceland defaulted on their debt, went bankrupt because they were unable to make their interest and principal payments because of a shrinking of their economy and a weakening of their currency. Greece, Iceland, Greece being another example, where again these countries faced sovereign debt crises that basically nearly collapsed or completely collapsed the entire economy. And it makes the recession worse because then the country, after it is in near default or in default, has to do spending cuts and raise taxes, which again further kind of limits the growth of the economy. Okay, I'm going to pause here. So, when we look more specifically at the Great Depression, again, we tend to look at the stock market crash in 1929 as kind of the beginning of it, but again, that's not entirely accurate. I mean, stock prices are useful, stock indices are useful to look at to kind of track how the economy is doing, but it's not exactly a one-to-one relationship. I mean, yes, stock prices plunged in 1929. People felt less wealthy and they spent less money, but there wasn't we don't really think of the Great Depression being severe in 1929, nor in 1930, 31, 32. We really see the depths of it being reached in 1933. Come in, why does the recession turning into the Depression get so bad in 1933? Well, you've got a combination of Congress reacting in a way where they're like, we need to grow our own economy, so let's keep foreign stuff out, right? So you could have these huge tariffs on imported things, which then cause other countries to retaliate and impose their own tariffs, which then reduces US exports and just generally raises costs. But then also in the 1930s, you see restricted immigration. You see people saying we're not going to have kids anymore, so population growth is declining. People aren't spending money on houses. Dude, does this sound familiar? It's kind of like we're doing many of these same things now, which I guess is why they've got the phrase, those who don't learn history are doomed to repeat it. But we are seeing a lot of these same trends right now. That's exactly what you see here, right? Is that 1929 again isn't really it's the beginning, but it's kind of not. I mean, things just get progressively worse as reactions to that decline. And then, you start to see things like the New Deal with FDR taking office, where you get the decrease in the unemployment rate as the government just starts hiring people. But if you look at the data here, right, after some initial progress, things actually get bad again in 1937. And it's almost like a resumption. And we quite honestly give, in my opinion, maybe too much credit to Franklin Roosevelt to kind of getting us out of the Great Depression. Because really the solution to the Great Depression was the fact that we entered a world war, right? That we had to fight the Germans and the Japanese. Because what that meant is that the government was going to spend way more money than it would ever otherwise to buy equipment that was going to get destroyed and to give money to people that were going to die. And if you can get through that war and you can survive that war intact, then the economy can grow quite a bit, which is obviously then what it does in the 1940s. And again, you see this here, is that the stock market does sort of recover during the FDR era, but again, starts to go down again in 1937 when there's real risk that the Great Depression is going to continue. And doesn't really get resolved until there's a good, healthy chance that we're going to beat the Germans and the Japanese in 1943, 1944. And so you see that at least something that FDR can take credit for is the fact that he did resolve the banking crisis with the establishment of the FDIC and some revised regulations on how banks exist. That bank failures, which were part of kind of the landscape of the 1932, 1933, all but practically is eliminated by March of 1933. And then obviously by 1934, with the FDIC existing, it's completely gone. And so when we look at then this issue of like, well, then why did the stock market fall in 1929? Well, the one way we could look at it is that, stock prices had gone up so much during the 1920s, it was bound for a correction. But also the other part of this was that the economy itself was in this debt deflation process where asset prices started to fall and they kept falling. And that caused goods and services to have falling prices, which then caused people to delay buying things. And it also, as prices of goods and services are falling, it means that interest rates have to rise even more to be able to still capture the real value. Which, if interest rates are rising, then investment falls even more. So the economy once it starts this debt deflation process, you get deflation in the economy as a whole rather than inflation. You've got prices falling, which is a worse problem than inflation because it stifles anyone from doing anything because people are always expecting that prices are going to go down. And why would you want to invest and expand your business if prices are falling? You would want some assurance of things. But when we look at like the research then too, again, of like, why didn't the Federal Reserve do anything to intervene to stop the banking crisis or to stop the debt deflation process, is that the Federal Reserve up until through the 1930s didn't really have a track record of being involved. The Federal Reserve System itself, no one was really in charge of it in terms of as a national thing. The individual branches still had a lot of power. And additionally, the Federal Reserve was incredibly reluctant to rescue banks that were insolvent because, again, of this moral hazard issue, which we saw again in the 2007-2009 crisis, where the Federal Reserve kind of refrained from doing things to stop bad behavior from occurring. This is a bit speculative. I'm not sure the authors, the authors are referring, I know, to some research out there that part of the reason why the Federal Reserve didn't intervene more strongly during the Great Depression was that there was a failure to understand the difference between nominal and real interest rates, and that there was this concern about excess. These were forces that were present. I'm not sure it can really explain, though, the failure of the Federal Reserve as much as the first two reasons. These reasons exist. I just don't think they're as important as the first two reasons. When we take those lessons we learned from the Great Depression to then the crisis of 2007, 2009, again, it's convenient and whatnot, just like you would with the Great Depression, say it started with the stock market crash, that you could say, well, the financial crisis of 2007, 2009 started with the housing bubble bursting. It's convenient. Just like it's convenient to say that the 2001 correction that we saw, and this would be when I was at the Federal Reserve, in 2001 we had a bubble in the dot-com bubble. This was when like a lot of internet companies started failing. Was in March of 2000, 2000 through 2001. Um, Not really caused by the attacks on September 11th, 2001. It was really the dot-com bubble bursting. Alan Greenspan, who was still Federal Reserve Chairman at the time, he had been in office since 1987. He His solution to the dot-com bubble bursting was he expanded credit even more. So it lowered interest rates and basically encouraged people to start investing in housing because interest rates were going down and down and down. And so between January of 2000 and May of 2006, housing prices are increasing because people are just buying more houses because mortgages are just really popular. And then to take advantage of the interest rate declining, there was this attempt to not make the interest rate products fixed, but rather variable. And starting in 2004, 2005, as Ben Bernanke becomes Federal Reserve Chairman, Ben Bernanke realized pretty quickly that there was this bubble and that we needed to take some action. He started to raise interest rates in general, and it caused the bubble to burst. So we see housing prices starting to decline in 2006 as we see variable rate mortgages starting to adjust upwards. And it's causing just a general credit crunch as banks start tightening their lending policies to be able to kind of control this risk that they know they have on the books. And as they start to reduce their credit, it causes housing prices to fall even more. Thus, you see this pretty significant decline from 2005 down to 2012, where housing prices are falling quite significantly. And really only resolved by the time you get to 2019, 2020. And now, if you look at it with the Case-Shiller Index, which kind of tracks housing prices, actually, let's look at it and see if we can do this quickly here. Yeah, we've largely. So during the Trump administration, still with Janet Yellen, as Janet Yellen would have been ending her time, and then Jerome Powell would have been taking it on. We see that, but then obviously now we're at a point where many would say, and the data would certainly suggest that that's true, where housing prices are unsustainable in terms of their height. Yeah, I'm not sure what the commentary is here for me here. These are pretty high. This is housing that is unaffordable for almost anyone. And so this would be nationally speaking that this is unaffordable housing. I guess you could look at this too here. Yeah, you could look at it, just different data sources too, and you see the same things going on here, where the housing is just unaffordable. When we look at what are the series of events in the contagion, you have BNP Paribas in August of 2007 not allowing redemptions of shares for MBS's mortgage-backed securities. That's in 2007. Then in March of 2008, we thought we had seen the worst of it, and that would be when Bear Stearns declared, was going to fail, and Bear Stearns was sold to Morgan Stanley for an incredibly good price. For I think it was $1 a share or $2 a share. And then we really see the bulk of the events happening in August and September of 2008. This would be where we saw in the last lecture where we broke the buck for the money market accounts. Lehman Brothers fails. Merrill Lynch sells itself to Bank of America to stop itself from becoming like Bear Stearns. We get to the last bullet point, which is the start of this lecture, is that the financial system froze. And that quietness is where you see the economy nearing collapse, the worldwide economy, not just US, but worldwide. That's all happening right there. So at the time, the federal government did intervene quite strongly to try to fix the system. It did it by getting involved in nationalizing things like Fannie Mae and Freddie Mac, which bought up mortgages. It did it by guaranteeing that money market mutual funds would not break the dollar. It did it by finding other ways to kind of control the shadow banking system, but it was doing more reaction than acting. And it found itself having to, again, work through this program called TARP, the Troubled Asset Relief Program, where basically the Federal Reserve did the unprecedented act of buying shares in the biggest banks. It meant that the government now, as a shareholder of banks, was going to have a say in executive compensation and in loans, but it was going to provide a great deal of capital to the banks to be able to do things. And one of the conditions is that these banks that are now deemed too big to fail have to undergo these stress tests in order to ensure that the banks are not going to fail during different simulated economic conditions. As we take that forward to COVID, the issue there was less with the Federal Reserve, but more with the government. The Federal Reserve did its part pretty quickly by meeting twice in a single month to cut interest rates to kind of encourage economic growth. But cutting interest rates alone isn't going to do it, right? When you've got a global pandemic. So what you really needed was the government. Now look at this amount again. Remember, this is what I was saying. With the Troubled Asset Relief Program, TARP, we were talking about $700 billion. Now we're talking about, in March of 2020 alone, $2 trillion with the CARES Act, providing lots and lots of money for lots and lots of different things. For us here in higher education, just as an example, I'm in public higher ed, right? Dude, I've never been as well funded as I've been since COVID started. The money's getting a little tighter now that the CARES Act money is run out. But let me tell you, it has been good while it lasted. And that's also done too, though, how households felt, unemployed people felt, is that poverty rates actually went down in the wake of 2020. Okay, I'm not sure here if we can look this up quickly here. Well, let's just look at it from the perspective of the savings rate. Right? People saved more money. They had lots of money coming in, courtesy of the CARES Act. And then people have just been drawing down that money, such that we are now near a point that's almost as low as it's ever been. Not as bad as August 20th, 2005, but pretty bad. And the Federal Reserve did kind of open up again some of its credit facilities to be able to ensure that banks were able to continue to operate and make out loans and whatnot. So we didn't really see during COVID any of the even beginnings of a feedback loop for a banking crisis. So we can't really think of 2020 in any way as a financial crisis, really, at all. So I'm not really sure why the authors of the textbook even put this here, because it really wasn't a crisis. There were challenges, but not a crisis. When we turn to what and we're going to look at this much more so in the next chapter, but when we look then again at what governments do when there is a crisis, it's typically something where there's a identification that a crisis exists, and then there's an attempt to both try to create a set of regulations to stop that crisis from getting worse, or to certainly stop it from happening again. But then there's also an attempt to respond to it, by the banks, and how are they going to work around those regulations that exist. And that's certainly what we see in the 2010s, where banks now face the stress test. How are they going to now be competitive with each other now that they face these stress tests? And we see this right now too. Also, the one way we see this today in 2024 is with the what's it called? The CFPB, I think. I think that's what it's called. Yeah, the Consumer Financial Protection Bureau, which imposed a lot of regulations on banks after the after the financial crisis, and banks ever since then have been trying to destroy. I'm not trying to be political here, but they've been trying to have the Supreme Court say that the CFPB is illegal in a number of different ways. The Supreme Court actually just decided last week, I think, was that is that the CFPB was a legal organization, and that was where you saw this from Justice Thomas. And what you see here is that, okay, so the Federal Reserve basically fails its first big test, the Great Depression. And it doesn't have an incredibly great record, even in the 1960s and 1970s. I think the authors are being quite generous with their first bullet point. I don't know if I would say it performed its role well. It created a crisis in the 1970s, in my opinion, with the Arthur Burns incident. That was kind of one of the first PDFs I made available back in Module 1 or 2. Yes, the Federal Reserve has intervened to both save Franklin National Bank when it failed, when we had some questions about commercial paper quality in 1970. But for the most part, the Federal Reserve has had some issues. And really, the best thing that we can do is we can look at 1987, when the stock market crashed. And unlike when the market crashed in 1929, we saw a great extent to which Alan Greenspan realized that we needed to provide liquidity to stop this debt deflation loop. Okay, I'm going to pause here for a second. So when we look at, again, these years that are after World War II and trying to assess the success of the Federal Reserve, I mean, you see some attempt in the 80s where the comptroller of the currency gives us a list of banks that are considered too big to fail, but we didn't really talk about it really too much, this too big to fail policy, until the 2007-2009 crisis. And then once we have that list, when we thought of this idea that deposit insurance in some cases, um, would they be able to have things like unlimited deposit insurance, such as what we got with Silicon Valley Bank and whatnot? It doesn't actually fix the problem, right? It just increases the extent to which we have a moral hazard problem where depositors don't really care because they know they've got that they're protected. And even the bank itself isn't too concerned because it knows that it's going to be able to continue to exist. The only thing that we start to see is that when the FDIC is the Federal Deposit Insurance Corporation, created in 1934, came under incredible stress during the savings and loan crisis of the 1980s. So in 1991, the FDIC Act was revised, and it did contain a clause, an exception, where if a bank's failure caused adverse effects on economic conditions or financial stability, that the FDIC and the Federal Reserve could intervene to stop a bank from failing if that bank's failure would cause even more instability. That was what was relied on for the 2007-2009 crisis, what was called more popularly a kind of a break the glass plan, which would be, right, if there's a fire or whatnot, right, you break the glass to like pull down the fire alarm. That's what you would do here. First started in March of 2008 when Bear Stearns was failing, and then again when Lehman Brothers, it was decided not to save that investment bank. That was part of the difference there, is that Lehman Brothers was an investment bank. But the consequences of allowing Lehman Brothers to fail meant that the Federal Reserve did need to intervene to save AIG, American International Group, which is an insurance company. So Lehman Brothers failed and the others didn't. Is that fair? Well, don't ask me. I'm just a professor. And so you see these kinds of playing favorites kind of game of why the Federal Reserve decided to save AIG but didn't save Lehman Brothers. One could criticize the Federal Reserve for saving some banks, not saving others, picking who the winners and losers are. I mean, that goes at the very core of what we are as an economy, right? Where we allow the market to pick winners and losers, not the government to pick winners and losers. I'm not trying to be political here. I'm just trying to say that that would be what the criticism was. The failure of Lehman Brothers in September of 2008 is largely considered kind of the worst moment in time for the financial crisis. And you can kind of see here, if we kind of create a scale, that would be where we see the moments of the greatest amount of economic stress, financial stress in the system, where we were the closest to failure. And again, that largely fails by AIG and other whatnot taking steps. And then the stock market finally reaches its lowest point in March of 2009. So what do we see here is that, again, the Federal Reserve intervenes to, create a system where the Federal Reserve intervenes to save down some financial firms, create marriages for others, right? Have some banks merge with others, and it kind of creates for us a system where banks are perceived not to be as risky as they were before because the FDIC, the Federal Reserve, the U.S. Treasury Department can all intervene. And you get the Dodd-Frank Act in 2010. You get the Federal Reserve kind of being forced to react to this idea that the government shouldn't be picking winners or losers, where the 1913 Federal Reserve Act is revised to say that the Fed can't make a loan for the purpose of assisting a single and specific company avoid bankruptcy. It didn't really stop the Federal Reserve from intervening to save, well, it didn't save Silicon Valley Bank, but it certainly got pretty heavily involved in that kind of situation. Um, the question would be is what will happen during the next banking crisis, financial crisis? By the Congress deciding adding this clause to it, it might create a situation where a contagion could happen again. And so again, here you kind of they made a nice little visual here, but we don't, when we think of that loop that typically occurs where the crisis, regulation, response, and response, you can kind of see that here with going from the Great Depression all the way till the 2009 crisis. And so this is kind of a nice image that kind of connects that too. That the 2008 2009 crisis is really just the ashes, the repercussions of the Great Depression from the 1930s. 80 years, 90 years later. Pretty scary. We do have other things where we kind of see some interventions here. One of them being Regulation Q, where we saw Regulation Q being used from the 1930s to the 1970s, where we saw banks having limits on interest rates that they could charge, where they could compete, where they could operate. Large parts of Regulation Q, the banking lobby has already removed most of those parts to it. Yeah, I mean, so today, the system that we exist in today, Regulation Q doesn't have much of an involvement anymore. Okay. What do I want to say? The last things I'll say here. I mean, we do have the savings and loan crisis, which was pretty significant. We saw our largest number of bank failures in 1980s with the savings and loan crisis that we hadn't seen since the Great Depression. And the perceived cause of that savings and loan crisis was that there wasn't enough regulation. So there was an acceptance of the fact that we needed to regulate more and that firms needed to pay for that. And we started to see these kinds of capital requirements that we saw before the 2008-2009 crisis, where banks that had certain levels that were in certain categories of capitalization had to have certain levels of tier 1 and tier 2 capital ratios, which is what we see during the stress tests that are applied today. Yeah, that's a financial crisis in a nutshell.